Hi, welcome to this video today, which is all about Forex hedging strategies. Now, hedging strategies are used by professional traders. Very often you'll find a trader trading, let's say, one currency pair will try and hedge himself off against an adverse move by trading in an uncorrelated pair, or maybe they're trading Forex markets, the spot market, and they'll hedge themselves with a different instrument, let's say options. Now, in this video, I want to discuss one of the most popular hedging strategies, which is promoted heavily online. It's used by retail traders. It will never be used by a professional trader, and that is to hedge off a loss rather than use a stop loss. Now, in terms of online, a lot of people promoting these strategies, saying they're minimal risk, or some even say they're risk-free. The logic is totally flawed, and the maths simply doesn't add up. So let me just show you why hedging a losing position is not a good idea and using a stop loss is a better idea by far. Okay, let's look at the logic and the maths in more detail. Right, let's look at hedging a Forex loss, the maths and the logic. Now, I'm just going to give a simple example. Let's say you had a long trade in the market and it goes into a loss of, say, $500. You decide you want to hedge with a short trade of equivalent size. Okay, so you put the short trade on. Let's say the short trade goes in your favor by $500. What is the result? The result is zero, because you've still got the loss on the other side. Okay, now let's just say your short trade made $1,000 in profit. Your result then is 500 profit overall on the two positions, and many traders would actually be very happy with that, but they cannot see the logic is totally ridiculous, because if the trader would have stopped himself out of the long and just gone short, the profit would have been higher. If we compare it to the previous example, when there was zero profit, you'd have 500. When you had 500 on the previous example, you'd have 1,000. Okay, remember that the traders who put these hedges on are not doing them because they believe in the trade. And there's no serious trader who would do this. Okay, if you're a serious trader and you're trading, professionally and with an edge, okay, you either want to be long the market, short the market, out of the market, or do nothing. You wouldn't do a trade like this because the maths doesn't add up. And it's just really trying to avoid a loss and make yourself feel better, okay? Or it is for many traders. And, like I said earlier, when the trader, gets like the 500 profit on both trades, he thinks that's the result. It isn't a result at all. If your strategy tells you you're wrong, you get out in the market. It's simply to avoid a loss. Hedging doesn't avoid the loss. The loss is there, okay? And also, as we've seen, it dilutes profit potential. A lot of people online demonstrate these hedging strategies. Of course, they do them all in hindsight. They would never do them with their own money, trying to make Forex look really low risk, as they call it, minimal risk. I've seen some people say it's a no risk strategy, which is ludicrous. So you want to avoid Forex hedging. If you're wrong on your position, you're wrong. You come out the market. You only take a position in the market if you have a definitive view of where it's going, not just going both ways for the sake of it. So that is the video for today. Thank you very much for watching me as usual. Take care and have a good day.